to start the discussion on pre-scene mock June 2025. Today's target is to go for section A. After that, inshallah, we'll go for section B as well. And then finally C. In accordance with IS2 inventories, what should be the value of this machine in the inventory presented in Brighty Companies of Financial Position December X9. Now listen carefully. Simply IS2. If you just recall IS2, cost or NRV, whichever is lower. That's it. December X3. This Brighty company has bespoke machine in the inventory that was manufactured to cater one of their clients' needs. The original cost of this machine was 5 lakh. Cost is 500,000. According to IS2, cost or NRV, whichever is lower. The selling price of this machine has been agreed 520. However, due to recent enactment, something change in the law of safety regulations, modification must be made to this machine at an additional cost 80,000 before it can be sold. So it means this modification cost, you have to bear it. Otherwise, you cannot sell it. So it's necessary cost to sell. So while calculating NRV, we have to deduct this. So selling price minus the necessary cost to sell. The client has agreed to pay 40% of additional modification cost by means of an increase in selling price. So client is not going to pay the entire 80,000. Client is ready to pay 40% of that. It means we have to just compare cost with NRV, whichever is lower. Already agreed selling price is 520. But now we have to bear this modification cost, which is 80,000. That is, you can say simply, this is your modification cost is actually necessary cost to sell. Without this, we cannot obviously sell this. So your modification cost, necessary cost to sell is 80,000. But entire cost burden is not on the company. 40% of that client is going to pay you. It means you can say additional revenue. So 80,000, if I take 40% of that, 32,000. Let's see what is NRV. 5,20,000 plus 32 minus 80,000. I'm getting 4,72. So according to IS2, cost or NRV, whichever is lower. Here now, NRV is logically lower than the cost. So on SOFP machine, this inventory will not be at 5 lakh, it will be at 4 lakh 72,000. Simply IS2, cost or NRV, whichever is lower. Question. Great. Who is paying 40%? Now look at this. The selling price of this machine has been agreed by upon 520. And this XYZ machine I have made for a particular customer, and that customer is ready to pay me additional how much? 40% of the modification cost. So don't you think so? You have agreed a price of 5,20,000 and due to change in the law, you have to bear a cost of 80,000 and your customer says, okay, 40% I will pay. So you're not going to take that? Okay. Using deferred income method IS20. In deferred income method, we simply take the grant as a liability, then slowly and gradually we amortize and convert that into an income. Accounting IS20, accounting for government grants and disclosure of government assistance. The following show the values of which grant and asset will be presented in the statement of financial position for the year ended June X4. Alpha company purchased a new machine. Okay. On 1st July X3 for 10 million. They bought a machine for $10 million. Useful life is 10 year. Useful life is 10 years. The acquisition was partially funded by the government grant. And let me share the other, why the 100% is not coming. Just a minute. Just a minute. Just a minute. Let me just share this other page. I hope, can you see that now? Of course, we cannot write, but I hope we can see that. Just reply. Okay. Yes. Alpha Company purchased a new machine on 1st July X3 for 10 million. Useful life is 10 years. The acquisition was partially funded by 3 million government grant received on the same day. Using deferred income method, IS 20 government grant disclosure, which two of the following values should be show the values at which grant and asset will be presented in the statement of SOFP on 30th June X1 at the end of the year. So the grant amount is 3 million. So please keep that in your mind. Let's go back. We are back. Government grant is 3 million. I hope everyone can see this one note, okay? So first of all, machine depreciation, can I say 10 million divided by 10? The depreciation is 1. So machine net book value will be 10 minus 1, 9 million. So non-current asset, it has to be 9. Agreed? After 1 year, of course, the value of the machine non-current asset will be 9 million. Number 1. Number 2, the government grant is 3 million. And this 3 million will be amortized over 10 years. So amortization of government grant. 3 divided by 10, 0.3. Logically, 0.3 million becomes income on 30th June X4. Repeat, out of 3 million deferred income, 0.3 becomes income. So the double entry of logically 0.3 is deferred income debit and profit and loss income statement SOCI credit by 0.3 million. Now listen. Total government grant, initially we received 3 million. Out of that 0.3 we have amortized. We are left with 2.7 million. Now please try to understand. We need to break this 2.7 million to current and non-current liability. And there are two nature of liabilities. One is income nature liability, another is expense nature liability. Deferred income is your income nature liability. In next 12 months time, the amount which company will earn, that is the current liability, and the amount which company will earn after 12 months, that is non-current liability. 3 divided by 10, it means in the next 12 months company will earn 0.3 million. So if I deduct 0.3 from 2.7, I'll be left with 2.4 million. Logically, 2.4 is my non-current liability and 0.3 is my current liability. Repeat, total grant is 3 million. 30th June X4, 1 year has been passed. So out of 3 million, 0.3 is already amortized. 0.3 million already has converted into income. Logically, we are left with only 2.7 deferred income. Now, what is the breakup of that 2.7? Out of 2.7, in next 12 months, the amount which will be converted into income, that is your current portion, 0.3 million, and remaining is your non-current portion. Now, let's find out. Non-current liability is 2.4 and current liability is this. So 2 and 3. I hope it is clear to everyone. Please reply before we move to the next question. Students. Great. Okay, that's clear. Thank you for appreciation. Okay. What is the depreciation charge of locomotive engine in the statement of profit and loss for the year ended December X3? They are asking depreciation charge of locomotive engine for the year ended. Okay. That a key company purchase a locomotive train. Depreciation they're asking for the engine. Okay. Be careful. Locomotive train on 1st July X3. From 1st July X3 till December X3, the time period is 6 months. From 1st July X3 till December X3, the time period is 6 months. Okay. The purchase price of the train is 9,75,000. Student, that is the purchase price of train. The locomotive engine needs dismantled at the end of its useful life of 7 years. Useful life is 7 years. At 1st July X3, the cost of dismantling are estimated 1,50,000 at the end of engine's useful life. At the end of 7 years period. Now listen, in July X3, the cost of dismantling are estimated to be at the end of 7 year, at the end of engine's useful life. Okay. Now listen carefully. This 1,50,000 is a dismantling cost which you have to bear at the end of engine's useful life. And engine useful life is 7 years. It means that I have to, number one, calculate present value of this dismantling cost, and double entry of the logically present value is I'm going to debit that engine and provision will be credited, because entire 1,50,000 actually relates to that engine. If you read it nicely, the entire 150 does not belong to the entire. I'm not going to dismantle the train. Okay. So this dismantling cost belongs to that engine. So whatever the present value comes, we will technically debit this engine and provision will be credited. Okay. The component of the train include the seats of the train, which comprise 15% of the purchase price, its exterior, which is 45% of the purchase price, and locomotive engine. This is what we are looking for, 40% of the purchase price. So number one, cost of locomotive engine. We'll take 40% of 9,75,000. If I take 40% of this, let's see what we are getting. 9,75,000, take 40% of this, 3,90,000. Dismantling cost is 150, but I need cost of capital. The discount rate they've given us, thank you, 6%. Now listen, we will add present value of dismantling cost, 1,50,000 into 1.06 power minus 7. At the end of useful life of engine, we have to dismantle this. Let me use a calculator. 1,50,000 into 1.06 power minus 7. Actually, I'm getting 99,007 with a little bit rounding of 59. If you ask me the double entry of 99,759, it is, you can say, the locomotive engine debit and provision credit. 3,90,000 plus 99,759. 4,89,759. We need to depreciate this. This is the total value of locomotive engine. Depreciation expense, only 6 months. Why 6 months? You can count the time period. The day we have purchased and till the year end, only 6 months have gone. So 4,89,759 divided by the life. Okay. Students, I'm getting 34,983. Let's see. With a little bit rounding off. Okay. Perfect. Please check. I hope everything is clear. Any issue you can ask. before we move to another question? Should we move to another question? Yes, okay. Thank you. Okay. What is the fair value per car for daily company in accordance with IFRS 13 fair value measurement? Okay, always remember, whenever your examiner gives you more than one markets, basically fair value is always determined, always decided on the basis of principal market. Principal market is the market where we have got the highest volume of similar transaction. Repeat, if my examiner gives me the information of more than one markets, I have to take the fair value on the basis of principal market. Principal market is the market where we have got highest volume of similar transaction, and fair value is actually equal to selling price minus transportation cost. We never deduct transaction cost. Transaction cost is the characteristics of the transaction. So fair value under IFRS 13 is equal to selling price minus the transportation cost, not the transaction cost. Okay, daily company has fleet 40 identical cars for which the accountant wants to calculate the fair value. Daily company has given you the information. Sale prices per vehicle, London, Birmingham, Manchester. Last year transaction, daily company. Total volume, this is important. 400,000, 5 lakh, and this 500,000. Birmingham. Can I say Birmingham is the principal market? Selling price is 3,500. Transportation cost is 100. 3,400. So repeat, whenever you have been given information like this, so always we decide fair value on the basis of principal market. Principal market is the market where we have got highest volume of similar transaction, and the formula of fair value is selling price minus transportation cost. Let's go ahead. Okay. Which two of the following factors could have led to this decrease? Okay, let's read. Which two of the following? The operating profit margin. Stop. PBIT. Operating profit margin. So operating profit margin is equal to PBIT upon sales. This is a normal formula. Operating profit margin of a spring company has dropped from 20% for the year ended to 16% for the year ending X2. So there's a drop from 20%. It has come down to 16%. Previously it was 20%. Now it is 16. Okay, don't forget the formula. And they're asking us which two of the following factors could have led this to decrease. Let's see. A spring company debt financing provider increase the interest rate. Can I say? False. Look at this PBIT. This is profit before interest and tax. It is before interest. Can I say even interest rate increases or decreases does not impact this formula at all? Yes or no? Please reply. Either interest rate increases, decreases does not affect at all because we are using profit before interest and tax. I hope it is clear. Yes, no effect at all. So this one is false. After conducting review of its tangible asset, Spring Company decided to reduce the useful life of its machinery and equipment. Can I say when you reduce the life, depreciation expense will increase? Yes or no? If you reduce the useful life, depreciation expense will increase. Can I say increase in depreciation expense will reduce your PBIT? Agreed? increase in depreciation will will decrease your profitability. So definitely point number 2 has affected this. Spring company was able to negotiate better deals and obtain price deduction on raw material purchases from its supplier. That is, can I say, this is false. This actually, this one will increase your PBIT, not decrease. Read it. Spring company was able to negotiate better deals and obtain price deduction on raw material purchases. So point number 3 could have increased your operating profit margin rather than reduction. And you are asking us, find out the two factors they have resulted in the decrease of operating profit margin. Spring company increased the wages of its managerial staff in response to the new government policy on minimized wage. Can I say when you're going to increase the wages, your profit PBIT will reduce? So logically 2 and 4. Is this clear, students? Two factors. They have affected your operating profit margin to decrease from 20% to 16. Okay. Calculate the gain on investment. Gain on investment to be recognized in Iringa company's statement of P&L and OCI. They are asking you the amount, okay? They're not asking you where to take that, okay? December X6. 1st April X5, Iringa company made an investment in ordinary shares. You should be thinking for IFRS 9. Paying 10 million for the shares and there's additional 1 million in broker fees. They paid 10 million for the shares, 1 million is a big fees. Broker fee, okay. The shareholding was less than 2% of Brown's company's ordinary share capital, okay. Ringa company made an irrevocable election. Stop. If you have made an irrevocable election for fair value through OCI, transaction cost will be added to the fair value of your investment in equity instrument. Repeat. If you have made an irrevocable election, then initially financial asset will be measured at recognized at fair value plus the transaction cost. It means at 1st April X5, logically your investment value is 11 million. 10 plus 1, it is 11. In case of fair value through P&L, we expense out the transaction cost, otherwise we capitalize. Okay. As at December X5, the fair value of the investment was 12 million. December X5, the value becomes 12 million. So of course, December X5 on SOFP, investment value is 12 million. An examiner is asking us the gain in the statement of P&L and OCI, of course, that goes to OCI. But in X6, not in X5. On 30th June X6, Erenga company sold the entire investment for a cash consideration 13 million. On 30th June X6, investment was sold for 13 million. Now listen to me carefully. Logically. What happens under IFRS 9? When there is an investment in the equity instrument and you have made an irrevocable election for fair value through OCI, it is written in IFRS 9 that immediately before disposal, before disposal, you have to revalue your investment, and whatever the change comes, that actually goes to OCI. So technically before disposal, you will remeasure your 12 million becomes 13 million. There's a gain of 1 million. Obviously that gain goes to OCI. But if you ask me, I'm again telling you, Under IFRS 9, when there's an investment in equity instrument which you have classified in fair through OCI category, it is written in IFRS 9 before disposal, immediately before disposal, you have to revalue your investment. Whatever the change comes in the fair value, that goes to OCI. And another very important point, if examiner asks you specifically, right now they have asked you what is the amount of the gain or loss. The gain amount is 1 million. Now I want to tell you something more. If examiner asks you specifically, give me the gain or loss on disposal only. If examiner specifically is asking you to give me the gain or loss on at disposal, not logically, when there is a investment in equity instrument which you have classified at fair value through OCI category, there will be no gain, no loss at disposal. Why? Now try to understand. 12 million investment has become 13 million. So what is the entry of 1 million investment debit, OCI credit? Now your investment is at 13, you are actually selling it also at 13. Logically, there is no gain, no loss on disposal in case when there is an investment at fair value through OCI. Is that clear to everyone? But right now the question is different. They are just asking the amount. I hope the entire explanation is clear to everyone. Is this clear? If question was give me the gain on disposal, if this was a question, we would have written 0. Let's move. What would be the finance cost in respect of property, lease in Highbridge Company's statement of profit and loss for the year ended June X9 to the nearest dollar? To the nearest dollar, it means not millions. Okay. On 1st July X7, Highbridge Company acquired commercial property through a 10-year lease. The information below is relevant to this company on 1st July X7. An initial lease payment 8 million was made. We know that when you are paying initially, or you can say you're paying in advance, then in your initial payment, there is no impact of finance cost. Annual lease payment of 16 million are due on 30th June each year in arrears. Now this is interesting. You are just paying 8 million initially. After that, you will be paying 16 million at the end of each year. Implicit interest rate is the interest rate which is included in the lease term. We know that if implicit interest rate is not there, then we go for incremental borrowing rate. But here implicit rate is given. The present value of lease payment on 1st July. Something went wrong. Okay, now 1st July X7 before initial lease payment was 100 million. And examiner is not asking us the finance cost of X8. Examiner is actually asking us the finance cost of X9, second year. Okay, no issue at all. 1st July X7 lease obligation in a day one. 100 million. We are making the payment on the same day. Initial payment 8 million. Can I say we're left with 92 million? 1st July X7. Okay, now 16 million will be paid at the end of the year. So before 16, there will be a finance cost, which is 6%. Logically, the year end is June. Okay, 30th June X8. Finance cost 6%. Let's use 6%. Please, I want someone else also use the calculator so that there shouldn't be any arithmetic error. I'm getting, I think, 5.52 million. 30th June X8 lease payment. We will deduct how much? 16 million. Lease obligation. So 92 million plus 5 million, 5.52 million. 5.52 million. Then minus 16 million. Sure, I'm getting 81.52 million. Check, please. Now, 30th June X9, finance cost 6%. Whatever comes, that is your answer. That is 4,891,200. You check this, the data was given in million, and here he's asking to the nearest dollar. I hope the entire calculation is clear to everyone. Please, any issue you can ask. Hmm. Let's move. Okay, what is this? What was the amount of cash consideration paid by Diamond? Wow, Diamond Company for investment in Sapphire Company. Okay, we need to calculate cash consideration paid. On 1st May X5, Diamond Company acquired 75% ordinary share capital of Sapphire Company through initial cash payment and agreement. Contingent consideration to the shareholder of Sapphire Company, the fair value of the contingent consideration was assessed at 3,50,000. Contingent consideration is actually 350. Diamond Company on this date. Diamond Company calculate non-controlling interest using fair value at acquisition date 1,50,000. Fair value NCR they have given us 150. Fine. Goodwill arising on the acquisition, great. Goodwill also examiner has given us. So still here examiner is looking very nice. The following figure for Diamond Company are relevant. Ordinary share capital is 6 lakh. Okay. Retain earning 1st January X5. 350. Student, but acquisition date is 1st May X5. We have acquired during there. Okay. Profit for the year ended December X5 is 140. The profit for Sapphire Company have accrued evenly throughout the year. Okay, man. We need to calculate cash consideration. If you just, whoever knows the format of goodwill can easily calculate cash consideration. How? Keep watching. Cost of investment. One is cash, which we don't know. The second is deferred consideration, which examiner has given us. $3,50,000. Fair value NCI examiner has given us. Thank you very much. Fair value of NCI 1,50,000. What is the total amount? No idea at all. Okay, less. Fair value of net asset at acquisition. Fair value of net assets at acquisition. And don't forget the acquisition date. Acquisition date is actually 1st May X5, okay? Net asset, they are equal to equity. Share capital of my subsidiary, they have given me 6 lakh. Retained earning till January X5, 3 lakh 50. Retained earnings till January X5. 1 X5. How much? 3 lakh 50. Now listen to me carefully, student. Acquisition date is 1st May. So what I need to do, basically 1st January X5, make it this 1st January. Examiner has given me the retained earning on 3 lakh 50 on 1st January X5. I need the retained earning on 1st May X5. So what do you need to do? Just add next 4 months profit out of this 140. 140 is the profit for the whole year. Just we are adding profit for the first 4 years. So 1,40,000, 4 upon 12. Profit of January, Feb, March, and April. So 1,40,000, 4 by 12. I'm getting 46,667. No, 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 no. It is 46,667. So simply PAT 1,40,000. I'll explain. Just give me 1 minute. Student, can you come here? Please check. Acquisition date is 1st May X5. Examiner has given you the retained earning at 1st January X5. So I actually need retained earning at 1st May X5. How to calculate? 1st January X5 retained earning, examiner has given me 3 lakh 50. After that, examiner has given us the profit for the whole year, which is from 1st January X5 till December X5. 12 months profit is given to me. How many months are pre-acquisition? Can I say 4 months is a period of pre-acquisition and logically 8 months is a post-acquisition period? Only pre-acquisition profit I'm going to take it because my acquisition date is 1st May X5. Directly at 1st May X5, examiner has not given me the retained earning. So I have to calculate that. Logically, if you ask me 3,50,000 plus 46,667, 3,96,667. This is the retained earning at acquisition date. Is this clear? The retained earning at acquisition date. 3,96,667. Now please come here. Now we have the net assets. Just add all of them. We'll get the total of net assets 6 lakh plus 350 plus 4,667. Total net assets are 9,96,667. If you recall, whatever the value is here, from this value, we deduct the total net asset, we get goodwill. Examiner has given us the goodwill. The value of the goodwill is 4 lakh. Now a simple reverse calculation. Can I say? Very easily I can calculate this question mark. How? If I add 4 lakh into 9,96,667. Can I say this is the value of total investment plus NCI? The value is 139,667. Now from this 139,667, if I deduct fair value of NCI and deferred consideration, can I say we can easily get cash payment? So logically, the cash consideration is 139,667 minus fair value NCF minus deferred consideration. Let's see. A little bit concept is there, but I believe more maths is here in this question particularly. So 139,667 minus 1,50,000 minus 350. Students, I'm getting 8,96,667. 8,96,667. This is your cash payment. 8,96,000. Please make sure that. So I strongly believe this calculation is clear. There was one concept that a student they should be able to calculate retained earning at acquisition number one, and after that is pure a format of goodwill. That's it. Now let's find out. Do we have the option? Yes. Delta. Let's go to another question. What should be the amount of warranty provision IAS 37 in Walker Company's statement of financial position on 30th June X5? What should be the amount of warranty provision in Walker Company's statement of financial position on 30th June X7? Fine. Walker Company's year end is 30th June X5. Walker Company provides 1 year warranty. They just provide 1 year warranty with each product sold during that. Past experience indicates that no repairs are required for 80%. 80% everything is fine, no issue at all. It means 20% there are problems. 80% of the goods sold by Walker Company, on average 15% require minor repairs. 15% require minor repairs. And the remaining requires major repair. Remaining, it means 5%. Of course, if 15%, 80%, no issue. 15% minor repairs, then 15 major. The company's service manager has estimated if minor repairs were required for all the products, if all the products required minor repairs, then cost would have been 120. But don't forget, only 15% they need minor repairs. And if major repair required for all the product, the cost would have been 1.2 million. But don't forget, major repair is actually required by only 5% of the products. So let's see the provision. 120 into 15% plus 1.2 million. Students, I'm getting 78,000. 80% no issue at all. 15% minor repairs, 5 major. That's it. So far, pre-seen mock looks decent, I would say. How will this change in accounting policy impact the financial statement of Gillard Company for the year ended 30th June X2? Gillard Company applied the cost model for its investment properties. Logically, for investment properties, you are allowed cost as well as fair value model, but logically, for investment properties, you should be using fair value model because it's your investment. Logically, nobody is interested in your investment that how much did you pay for that. Logically, everyone wants to know what is the fair value of your investment. Gillard Company applied the cost model for its investment properties for many years. Fine. Starting 1st July X when the company shifted to the fair value model for investment properties. Nice. Since fair value were higher than the, now listen, IS 40 investment property under fair value model, no depreciation. Second, whatever the change comes in the fair value that goes to income statement, that goes to SOCI, statement of comprehensive income. Since fair value were higher than the carrying amount for all the investment properties, a fair value of 40 million was recorded in the financial statements. A fair value gain, a fair value. Fair value gain 40 million was recorded in the financial statement. So you can say investment properties debit by 40, income statement associated credit by 40. There's no change in estimated useful life of the investment properties. Okay. How will this change in accounting policy impact the financial statement of Gillard? Now listen carefully. Logically, your investment properties, they are debited by 40. Your income statement, P&L, associates credit by 40. So definitely, can I say profitability has increased? Yes or no? Please reply on this first. Comment on that. We'll see what choices they have given us. Now, I want to say one thing. Due to rise in the profitability, can I say the total equity of the company will also increase? Due to rise in the profitability, total equity of the company will also increase. Please comment on that. Yes or no? Due to rise in the profitability, equity will also be increased. Profitability is a part of equity. Now come here. How will this change in accounting policy will impact both operating profit margin and gearing will? Students, when your business equity will increase, then logically gearing will reduce, not increase. Gearing is debt to equity ratio. When the equity is increasing, then percentage of gearing will not increase. The percentage of gearing will decrease. Both profit before tax and gearing will, wrong. Gearing will decrease, but profit will increase. Profit before tax will increase and gearing. This is logical. Actually, we know that profitability is increasing. If you just recall gearing, assuming if you're using a formula debt upon equity, or even you are using debt upon debt plus equity, whichever formula you are using, try to understand. Due to profitability, your equity will increase. Can I say due to increase in equity, gearing will reduce no matter which formula is you are using. When your equity is increasing, then debt to equity ratio will not increase, it will decrease. I hope it is clear to everyone. Please reply. Students, I'm waiting. So which option? The answer is C. Okay, now let's move. Which of the following terms represent the entry price at which the entity would acquire the asset or incur a liability at its current market prices? So entry price is simply the current cost. Right now, what is the value? That's it. It's not about what is the fair entry cost. What is the current cost right now? That's it. Nothing else. Yes, you can put the if it is difficult for any student to directly correlate the formula, increase or decrease, you can put the numbers, no issue at all. Okay. In accordance with IAS 10 events after reporting period, which statement is correct regarding dividend declared after reporting? So dividend declared after reporting is just an non-adjusting event. You have to disclose it only before the financial statements are approved. It's a non-adjusting event. Let's say what they are saying. This should be recognized as liability at the reporting date. False. It's a non-adjusting event. You have to just disclose. They should not be recognized as a liability at the reporting date. True. They should be considered as an adjusting event. It's false. It's a non-adjusting event. They should be recognized as, can I say dividend is not your expense? So logically B. I hope it is clear. Let's move. What is the diluted EPS of Charlotte Company December X5? Diluted EPS, okay? where we make an assumption all of your potential ordinary shares, they become ordinary in day one. What will be your EPS? That is diluted EPS. Let's see. Charlotte company has issued share capital, has issued share capital 5 million, okay, on 1st January X1 at a par value 1. Now listen to me carefully. Has issued share capital 5 million, par value is also 1. Now listen, if your issued share capital is 5 million and par value is also, par value is $1, in that case your number of shares and capital both are equal. Otherwise what happens? Ordinary share capital divided by par value gives you number of issued shares. Repeat. Normally we take ordinary share capital divided by par value. But can I say when par value is $1, then amount of your share capital and number of shares, they will be same. So 11x5, you have got number of shares 5 million. On 1st September X5, Charlotte company made a bonus issue of 2 new ordinary share for every 5. 2 new shares for every 5. Bonus fraction. Shares, number of shares after bonus divided by shares before bonus. Simply shares after bonus divided by shares before bonus. Can I say before bonus, whoever is having 5 shares, after bonus, they will become 7. A bonus fraction, simply shares after bonus divided by shares before bonus. Whoever is having 5 shares before bonus, after bonus, they will become 7. Okay. And this fraction is applicable on all those shares which are there before the bonus. Okay. Profit after tax, after that, there's no other ordinary shares. If there are no other ordinary shares, there's no need to do time apportionment and calculate weighted average so nicely. You can directly do this. Directly just take opening shares into 7 by 5. Logically, your weighted average shares for ordinary, your ordinary weighted average number of shares are 7 million. There's no need for the time apportionment. I could have done the time apportionment, everything, if there were other transaction also. There is no other transaction. And another example, if in the entire question there is only a bonus issue, if in the entire question there is only a bonus issue, then you just take that bonus issue, that you just assume company has made the bonus issue at the start of accounting period. Repeat, when in the entire question there is only a bonus issue, whenever organization has made, just make a simple assumption that that bonus was made at the start of accounting period. So simply at the start of accounting period, instead of 5 million, you have got 7 million shares. But we are not calculating basic EPS. We need to calculate diluted. Profit after tax, they have given us 7,56,000. Charlotte company has convertible loan as a potential ordinary share. $3 lakh issued at 5% interest. The loan can be convertible into 60 shares per $100 after 5 years. Now listen, in this 7 lakh, I will add shares from conversion. Shares from conversion. 300,000. The conversion ratio is 60 upon 100. So 3 lakh, 60 upon 100, I'm getting 1 lakh 80,000. Add this 7 million. So total number of weighted average share for diluted EPS is 7.18 million. Now profit after tax, which they have given us, 7,56,000. If you recall that in this 7,50,000, we have to add, because when your convertible bond becomes ordinary share in day one, that is what we make as assumption while calculating diluted EPS, then I'm not going to pay any interest. There will be interest saving. Due to interest saving, my earnings will increase. I will have to make that interest saving after tax. So 300,000. Simply add post-tax interest saving. Post-tax interest saving. 300,000. The interest rate is 5%. What is the tax rate? They should have given us. Tax rate is 30%. Just multiply this with 70%. If tax rate is 30, you want to make something after tax. So just multiply that with 70%. If tax rate was 20%, I would have multiplied this with 80%. 3 lakh into 5%, then 70. Student, I'm getting 10,500. Your revised PAT. Your revised PAT is 7,66,500. Revised PAT. Now, very easily I can calculate diluted EPS. Revised profit after tax divided by the weighted average shares 7,180,000. Let's see what we are getting. Students. 7,56,000 plus 10,500 divided by 7,180,000. Students, I'm getting 0.10675. Now let's see. If you don't get the same answer, go to the nearest one. Now, which option is nearest? Can I say the first one? Look at this. 0.106. This 6 will make 0 to become 1. Is that clear? The first option is the nearest one. Alpha. Okay. Which of the following is correct regarding Leslie factoring of trade receivable for the year ended 30th December X3? Okay. We have to just see either the data are sold or not. December X3, Leslie company sold 2 million of the trade receivable to Relay company. Sold 2 million of trade receivable. Relay company. Leslie company receive an immediate payment 1.8 million. Under the factoring agreement, any receivable not collected after 6 months will be sold back to Leslie. Now listen, look at the arrangement. You are saying I have sold my trade receivable having carrying amount 2 million for 1.8 million. I've received 1.8 million, but there's an arrangement. If factor company, any amount which factor company has not received, I have to return. Now my question is, if factor company was unable to even collect a single dollar, so can I say whatever amount 1.8 million you have received, you have to return each and every amount. So logically your data are not sold. So whatever amount you have received, technically it is your liability. 200,000 should be recorded as an administrative expense. Actually, no. Data are not sold. Receivable should have been removed. No. How come it is a revenue? Selling receivable is not your revenue. Receipt 1.8 million should be your loan. D. Delta. I hope it is clear to everyone. Yes or no? Logically, risk and rewards of your data are not transferred. Since the risk and rewards are not transferred, so whatever amount I have received, it is a loan for me. Any issue? Is this clear? Tell me, students, so that we can go ahead. Please reply. Let's quickly discuss the last multiple choice question. Pre-seen mock June 25. Which two of the following conditions allow a company to be exempted from consolidation according to IFRS 3 business combination? Which two of the following conditions? Basically, if this is the scenario that APLC has got 100% holding in assuming B Limited, and this company has got 90% holding in CPLC. I'm just assuming it, okay? Logically, there are two groups. One is A, B, and C. But there's one more group. B and C. So ideally there should be two group of accounts. One is prepared by APLC, that is which represents ABC. Another is B and C only. But there's a possibility of B Limited getting exemption from not to prepare the group accounts. B Limited. Why? B Limited can say simply that ultimate parent is preparing the group accounts, and there's a possibility that ultimate parent does not have any problem with that B Limited is not preparing group accounts with CPLC. Let's see. But this exemption is only applicable on B Limited. A cannot be exempted, okay? Ultimate parent produces financial statement available to the public. Yes. The subsidiary trades in a distant foreign country, wherever your subsidiary is trading. It does not mean that you get exemption from group accounts. No. The company is a wholly owned subsidiary of another entity. Yes. B is a wholly owned subsidiary of A. Another entity and its other owners do not object to the parent not presenting group financial statements. So ultimate parent is having no issue at all. Plus, both the conditions are met. Ultimate parent is preparing group accounts which are available to the public. And plus, the final point is B Limited itself is a wholly owned subsidiary of another wholly owned subsidiary of another company. The business nature is different, no. So logically A and C. So students, that was all about section A, MCQs of pre-scene mock June 25. And the plan is to discuss section B tomorrow with you. So don't worry at all. And then we'll go towards section C. So every day, one section will be discussed and you will always be given the opportunity to attend the class. So thank you very much. And let's see this time who's going to break my FR students record of 92 marks. So let's see. Thank you very much.